Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax developments to the OECD's Pillar 2. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're back in our Policy on Demand studio in Washington, D.C., where I'm excited to welcome back Pat Brown. Pat is a 7-time veteran of the Cross-Border Tax Talks podcast and co-leads our Washington National Tax Services practice. Pat also worked in private industry for 16 years, where he was the VP of Tax and Director of Tax Policy at GE. Pat, welcome to the podcast. It's great to have you back on.
It is great to be back on, Doug. Thanks.
All right. Well, a lot of development since we've last talked, particularly in the context of Pillar 2. But before we begin, I wanted to let the listeners know that as co-leader of our WNTS practice and part of our tax policy panel, you have listened to many of my podcasts for any number of technical and policy reasons. So for that, I am both very grateful and remorseful. So my first question for you, what podcast have you enjoyed the most, or is there a prior podcast that was particularly memorable for you?
I mean, Doug, it's such a long list, of course, and they're all so excellent. I would say, in particular, where we've had some client perspective, and I would single out Tad Fowler and podcast with him. You may have done more than one with him,
Two,
as a matter of
that's
fact.
right.
Yeah. That's always great perspective. I think, frankly, the exchange between you giving your perspective and Tad from his perspective, I think it's a really great, it was a really great interplay, so I really enjoyed that one.
Well, thank you. Yeah, and it's always neat to get a taxpayer's perspective,
Indeed.
Particularly as an advisor.
Indeed.
So maybe a follow-up question, Pat. Who is your least favorite guest on the podcast?
Rebecca Lee.
Rebecca Lee. 6-time participant to the Cross-Border Tax Talks podcast.
And let's leave it there.
Okay, yeah, I guess you're just not a big crypto or foreign currency person. All right, so let's get away from the gossip and into the world of Pillar 2, Pat. A lot of ink has recently been spilled about what are good tax credits for Pillar 2, particularly as it relates to the Inflation Reduction Act's plethora of green energy credits. So before we dive into this, because this is a complicated and technical matter, why does it matter if green energy credits from the IRA, or frankly any other credits, are a good covered tax in the context of Pillar 2? Yeah,
and you're right. This is a complicated area. And I don't think there's a way to shortcut it. We're going to have to get into a little bit of arithmetic here.
Yeah.
So when you do your computations under Pillar 2, obviously it's a minimum tax, and the rate is 15%. So you say 15% of what? So that's a fraction or a percentage, and they're thinking of it as a fraction. You've got a numerator and you've got a denominator to a fraction. Your denominator is the income that is within the Pillar 2 base. And as we know, the starting point for that is generally your financial statement income within a country, and you make adjustments. And there are a lot of adjustments you make, but just as a starting point, the starting point for your denominator of that fraction is your income as measured for financial statement purposes. The numerator, of course, is tax, right? This is a minimum tax regime, so it's basically establishing a tax rate. And the starting point for your numerator is what Pillar 2 refers to as covered taxes. Mm-hmm. And again, the starting point for that is taxes that are reflected on the income tax line of your financial statements. Now, there are a number of adjustments to this, so it's important to reflect that we're only talking about the starting point here. But in that numerator, which is financial statement taxes with adjustments, one of the things that gets reflected or must be carried through in your calculation relates to tax credits. And as it happens, under the Pillar 2 computations, some forms of tax credit are treated as a reduction in covered taxes, that is to say they reduce your numerator. Other forms of credits do not, and we'll talk about this more as we get through the computation. But to sort of preview for folks, under the rules now, particularly after the most recent release of administrative guidance, there are 3 different potential buckets for credits to go into. There's a bucket for qualified refundable credits. There's a bucket that I'll still call the residual bucket, sort of all other credits that are not refundable credits. And then there's this additional bucket that was added in the administrative guidance for what the administrative guidance refers to as qualified flow-through tax benefits and credits that fit within that bucket. So we have 3 different buckets we have to think about, and depending on which bucket your credit sits in, it will either have a reduction effect on your numerator in that fraction, or it will not. And that is the essence of the question with respect to credits. In which bucket does my credit go if I've got a tax credit? Does it go in refundable, residual, or in this new category that just was released?
Right. And so if it is a good covered tax, and we'll kind of unpack, because that's not a technical term in the model rules or commentary, but if it is a good covered tax, then it generally reduces the numerator, which could potentially result in top-up tax being
drop
owed,
you closer to 15% or below 15%.
or below 15%. Right. And if it is not a good covered tax, and then therefore goes into the denominator, then it will effectively increase the denominator. Which can be somewhat dilutive, but obviously not as dilutive if it ends up in the numerator.
Correct. So the way to think about an increase in the denominator, if you increase the denominator, again, let's think about this as tax professionals, you're increasing the denominator, it's like you're adding income that potentially is not subject to tax. So if you add a lot of income that's not subject to tax, it will have a reducing effect on your effective tax rate. Of course, if you directly reduce your tax liability, that's going to have a more significant effect, dollar for dollar, on your effective tax rate. So changes to the denominator are not irrelevant in the Pillar 2 computation, to be clear, but they will have a much less pronounced effect than changes to the numerator. And that is one of the reasons why this is such an important conversation for companies for whom these credits are an important part of their business.
Right, and obviously also an important piece for policymakers, as we've already seen some reaction from various members of US Congress that now understand that to the extent that some of these credits may not be considered good covered taxes, it could mean that some other territory is effectively picking up the tax from a credit that was oftentimes designed to influence certain types of taxpayer behavior.
Exactly.
Okay, so let's dive in then. We're going to double click here on the model rules and commentary, and we'll come back to the administrative guidance. So how do taxpayers generally determine what's a good covered tax for Pillar 2 under the model rules and commentary? And you already previewed qualified refundable tax credits.
Yeah, and so let's talk a little bit more about this concept of qualified refundable credits. And again, under the model rules, credits fell into 2 buckets and 2 buckets only. You had qualified refundable credits and you had all other credits, all other tax credits. Qualified refundable credits were credits as defined under the model rules that had to be payable in cash within 4 years if a taxpayer did not have sufficient tax liability against which to use the credit. So it was not, there has been some confusion on this. It is not the case under the model rules that a qualified refundable credit has to be paid out in cash, or indeed even that the government is obligated to give every single taxpayer the option to receive it in cash. The requirement is if a taxpayer meets the criteria for the credit, and over a 4-year span, starting in the year in which that taxpayer gets eligible for the credit, the taxpayer doesn't have enough tax liability, right? They're loss making, so they don't owe any money to the government. And so as a result, they have insufficient tax liability against which to use that credit. Then the government effectively has to write them a check. That's the criteria that's described in the model rules for a qualified refundable credit. If a credit satisfies that qualified refundable credit criteria, it is treated as the equivalent of a government grant. And as a government grant, it is not treated as a reduction to your covered taxes. It is rather treated as additional income to you. As additional income, as we were talking about, it affects the denominator. It doesn't affect the numerator of your ETR fraction. All other credits under the model rules, all other tax credits under the model rules go into the numerator of the computation. And so what that means is if you receive $10 of a non-refundable, this residual category of credit, that goes directly into the numerator of your ETR, potentially dropping you below 15%. So that distinction between refundable and between qualified refundable and all other credits is an enormously significant distinction under the model rules.
Were these lines that were drawn based on general accounting principles?
I'd say as a starting point, yes. Okay, So we know, and I'm not an accountant, but we know that the financial accounting rules treat refundable credits in general differently. They treat them, again, as equivalent to a government grant. And that means what people in the accounting world say they're accounted for, quote, above the line, meaning above the tax line, right? That distinction between is it above the line or is it below the line is something that essentially the OECD, in drafting the model rules, grabbed onto and said we should treat refundable credits differently because they're accounted for above the line. All other credits are going to go through your ETR. Now, what's interesting about that, and we'll come back to it, Doug, is the financial accounting treatment of credits that come through, quote, below the line is not necessarily straightforward, and there are some real differences. So it's not as simple. And to a certain extent, I think the OECD got ahead of itself on its messaging a little bit on this, and essentially saying, why did we treat qualified refundable credits differently? Well, we're just following financial accounting. Well, it's not quite that simple. The distinction between a refundable credit and other credits is real in the financial accounting world. I think it's important that these refundable credits are accounted for above the line like government grants. But it's not as simple to say, and therefore we're just following financial accounting, we're just following GAAP. They're not just following GAAP because the treatment of all other credits is much more nuanced under the financial accounting rules. And for Pillar 2 purposes, you don't get any of that nuance. They just stick them right into the numerator of your ETR and drop it down.
Yeah, and I think that's the important point. I think that there's maybe some misconception that, well, if it's above the line versus below the line, if it's below the line, impact the denominator. That's not where the model rules and commentary drew the line. They created this definition of a qualified refundable tax credit. And so really, despite whether it's IFRS or GAAP or whatever accounting standard, that is not ultimately determinative for purposes of Pillar 2. You have to meet this definition.
And that's an important point. And you can understand why the OECD did it the way they did it, because they are trying to write rules that are applicable across a multitude of financial accounting standards. So I'm not unsympathetic to the notion of we need to draw lines here. The starting point for it was this general concept from financial accounting of refundable credits being above the line. So they grabbed onto that concept, but then they had to make some changes to it to have a single standard that applied across multiple accounting frameworks.
So the classic example, I think, that we've seen is the US R&D credit versus the UK R&D credit. Can you shed a little light on those?
Yeah, so the US R&D credit, which I'm sure a lot of our listeners are very familiar with, is one of our general business credits, one of the standard, if you will, US general business credits. It is, I believe, by far the biggest of the general business credits in terms of its impact on the fisc. And obviously, again, really, really important to a lot of companies. It is not a refundable credit, to be clear. If you never make money and you engage in research activities that were otherwise eligible for a research credit, you will never get any monetary benefit from the credit because you never have tax liability and therefore you're unable to ever monetize the credit. The UK has a refundable form of an R&D credit. The UK is not the only country, but there's certainly a prominent example of a country that has a refundable tax credit. So that distinction between a refundable R&D credit in the UK and not a refundable R&D credit in the US drives a very different analysis under Pillar 2, which is what we've just been talking about. So if you do research in the UK, you qualify for a UK R&D credit. This, by the way, is of course true whether you're a US company or a UK company or any other company. It's you have activities in the UK that qualify for the UK credit. Well, that credit will be treated upon your qualification or your receipt of that credit, that is treated as affecting your denominator. It's treated as additional income to you. May have an impact on you for Pillar 2 purposes, but that impact is going to be quite muted relative to you perform those same activities in the US, qualify for the US R&D credit. That credit will reduce the numerator of your fraction. It will reduce your ETR much more significantly for Pillar 2 purposes than if you did exactly the same activities in the UK and qualified for the UK credit. So very similar in a kind of high-level design, government saying we want to influence taxpayers to do more R&D and do it in our country. Okay, so that's what both the US and the UK said. Different approach to design, driving dramatically different Pillar 2 outcomes.
Yeah, I think one of the things that has surprised me as I've looked at a number of taxpayers, it's that particularly for those that are doing a lot of R&D in the US, And I think it's maybe been a surprise to a number of policymakers, particularly with the US statutory rate of 21, add a few points for state taxes, that the R&D credit, because it is not a qualified refundable tax credit, it reduces the numerator and can cause a US taxpayer to fall below the 15% for GLOBE purposes.
Right.
And what that means, to remind listeners, is that if the US is a subsidiary of a foreign parent that has implemented the income inclusion rule, that could mean a top-up tax on the US, so effectively that R&D credit is now being paid to another foreign government.
Yes.
Or to the extent that the undertax profit rule comes in and you have a US parented group, then potentially a subsidiary of the US, a subsidiary jurisdiction could collect the top-up tax.
Yeah, and I think it's an important thing as well, Doug, to remind our listeners, and I know we've talked about Pillar 2 a lot in the past, but you mentioned 21% US rate, state taxes on top of that, and I'm sure some folks might be asking the question, well, how many companies are really qualifying for enough R&D credits that they're actually going to go all the way from a 23 or 24% rate down to below 15? The answer to that question is there are a lot of limitations and restrictions and special definitions within the model rules that even though your starting point for US GAAP purposes might be 23 or 24%, after you go through the refinements of the Pillar 2 rules before you layer on credits, you may be a lot closer to 15%, actually, and then you layer on R&D credits and you discover, wow, even though my US GAAP rate in the United States may be 18 or 19%, my Pillar 2 rate might be 12% after I layer in these R&D credits. And to your point, now what's the consequence of that? The benefit of those R&D credits goes to some non-US government, whether that's through the IIR, if it's a sub of a non-US parent, or the UTPR. And the policy implications of that are, of course, was it Congress's intention in enacting the R&D credit to shift money from US taxpayers to foreign treasuries? I think we know the answer to that.
I think we do know the answer. Well, you already alluded to this, Pat, but why would it be difficult for the US just to convert to refundable credit? So just make the credit like the UK. Why would that be difficult?
Yeah, so technically it's not hard at all. In fact, as we'll talk about, there are credits in the US system that are what we use the terminology direct pay, but it's essentially, I would say, economically equivalent to just a refundable credit. And so as a technical matter, you and I could scratch it out in the next 30 seconds to turn the US R&D credit into a refundable credit. The reality is there are significant revenue implications to that, and there are significant policy implications. So on the revenue side, again, I mentioned the R&D credit is, I believe, the largest of our general business credits. If you turn it into a refundable credit, you would significantly increase the revenue cost to the US government for doing that. And as a result, Congress will have to take on board, obviously in an environment where there's a lot of fighting on Capitol Hill about how much money we're spending, how much are we spending too much, and what should we be spending it on. Now you layer in something that is essentially not from the design of US legislators, but rather from foreign governments essentially sort of trying to impose upon the US system changes to the way we design our credit. So you can understand why there's some discomfort with that on Capitol Hill. That's from the revenue perspective. From a policy perspective, it's important to note that you change the nature of the beneficiaries of the US R&D credit, right? So if you think you and I have a great idea for a startup business, let's say, we do it in my garage, we start a business up, we never make any money because it turns out it was a dumb idea and our business goes out of business in a couple of years, right? That would be a business that under our US R&D credit would never qualify for the R&D credit because we never made any money, right? If you had a refundable R&D credit, you would end up essentially with the US government funding a lot of these kinds of activities that maybe never make money. There's a debate, of course, to be had amongst economists about whether or not that's a better design or a worse design of an R&D credit. What it is a very different design of an R&D credit. And so I think before Congress would take something like that on board, they would want to give a lot of thought to the revenue implications and the policy implications of it. And the situation we find ourselves in now is people asking the question, well, why don't you just change to a refundable credit to comply with Pillar 2? That's not the way Congress thinks.
No.
And so that's, I think, and, again, part of what's giving rise to some of the discomfort we're seeing.
Very helpful. So now let's compare that to the Inflation Reduction Act. So what types of credits have we seen in these green energy credits, and are they refundable, kind of quote unquote, under the model rules and commentary?
Yeah. So, and this has been an enormous change to the landscape for general business credits in the United States. The Inflation Reduction Act, which was enacted last year, the Biden administration's really signature achievement from their perspective, and really intending to bend the curve or change the trajectory of investment in the green energy space. A lot of new credits enacted, so things for carbon capture as one example, refinements, enhancements to existing credits like the production tax credit for wind energy, a whole wide panoply of credits, significant expenditure of money by the Congress to fund these new credits. Most of these credits are not refundable credits. Again, we use the terminology direct pay for most taxpayers. A lot of the green energy credits that were enacted in the Inflation Reduction Act are direct pay or refundable if you're a tax exempt, effectively, certain categories of tax exempt. And that sort of makes sense, right? Because if you're not a taxpayer, you can't benefit from a tax credit unless it's direct pay. Okay. For some categories of credits that were enacted in the Inflation Reduction Act, I think there are 2 or 3 of them, they are eligible for direct pay for all taxpayers for at least a period of years, so 5 years. They're eligible for direct pay, meaning that if you don't have sufficient tax liability, you raise your hand and say, Uncle Sam, I need a check, and Uncle Sam sends you a check. And so that's the nature of these direct pay credits. We see this is not something we do a lot, but in the Inflation Reduction Act, and I should point out in the CHIPS Act, the Advanced Manufacturing Credit in the CHIPS Act is also a direct pay credit. So we have seen a significant expansion of this world of direct pay or refundable credits as a result of these enactments from last year. Still, most of the green energy credits for most taxpayers are not eligible for direct pay. They are eligible for this other category of credit treatment called transferable credits, which I'm sure we're going to talk about.
Yeah, so let's move there. So the transferable credits, and you already mentioned, projects include solar, wind, geothermal, carbon capture, clean hydrogen, and biomass.
Right.
So what is a transferable credit?
Yeah.
Is that analogous or the same as refundable?
Yeah. So it's definitely not the same. Because Uncle Sam is not going to be writing anybody a check for a transferable credit. But the concept of a transferable credit, I'll say this, sort of a nifty idea. I am a taxpayer. I want to engage in more of an activity that Congress wants to incentivize, whatever that activity would be, right? Additional generating of energy from renewable sources. I want to engage in more of the activity. And Congress wants to incentivize me for doing that. The problem is I don't have enough tax base. I can't monetize fully, or I'm concerned I won't be able to monetize fully the tax credits that Congress has enacted in the Inflation Reduction Act. So Congress anticipated that in the Act and said, we will create a mechanism, to my knowledge, it's a brand new mechanism, not something we've ever done before, a new mechanism to allow me, the taxpayer who is engaging in this activity, but is concerned that I may not have enough tax base, I will have the ability to sell my credit to you, you have sufficient tax base to utilize the credit. You're not in the business of making these investments, but you have the tax base to utilize the credit. Now, what remains is you and I have to agree on a price, right? And so if the credit is worth, to me, if I could fully monetize it, 100 cents on the dollar, you're not going to pay me 100 cents on the dollar for it because you don't have any, therefore you don't have any economics, any positive economics associated with that. So we will settle on a clearing price. Maybe it's 90 cents on the dollar, maybe it's 85 cents on the dollar, maybe it's 98 cents on the dollar. Whatever that price is will obviously be determined by the market. And that, again, not by accident. Congress very clearly thought about this and decided that this is a mechanism they wanted to enhance the attractiveness for a broader class of taxpayers to invest in this space, make the credits transferable. Now, they're transferable once. So in other words, you can't transfer, I can't sell it to you and then you sell it to somebody else. But the decision as to when you exercise, when you're going to transfer the credit, it can be made on an annual basis. So I can say, I've got enough capacity this year. I can capture 100 cents on the dollar of that benefit. But next year I may not. Turns out next year I don't. I sell it to you. One of the things, again, that's intended to do is remove some of the uncertainty for taxpayers making these multi-year capital investments. Like, am I going to get the full benefit of these credits, or am I going to be stuck in a situation where I won't be able to monetize it? Well, if I'm Congress, I want to remove some of that uncertainty by saying, if you can't monetize it, you can sell it. You can sell it to somebody else. Now, you're not going to get 100 cents on the dollar, but you'll be able to monetize it by selling it to somebody else. So it's really intended to take some of the uncertainty over these multi-year investments out of the system and allow taxpayers a greater latitude to commit to these investments, knowing that they'll be able to monetize all or nearly all of the credit.
So I think many taxpayers and policymakers were hopeful that they may receive some guidance from the OECD that would tell us that this transferable nature of credits would be analogous to qualified refundable tax credits.
Yeah.
So that brings us to February of 2023.
Yes.
Where the OECD issued its first round of administrative guidance on Pillar 2 as additions to the model rules and commentary.
Yes.
So the US Treasury Department immediately came out with the statement that said, and I'm going to quote, Pat, that the package of guidance provides certainty on several key issues. Examples include protection of green tax credits, including those that were included in the Inflation Reduction Act, close quote. It also mentioned the low-income housing credit. Before we dive into the administrative guidance, Pat, how does that statement from Treasury resonate with you?
Yeah, I think Treasury got a bit over their skis in that statement. I think I can understand why Treasury really wanted that to be a fully true statement in terms of giving certainty to taxpayers about this stuff. The reality is, as we unpack what was actually in the administrative guidance, the relief that's actually provided in that guidance to credits is limited. It will apply to green energy credits if you make investments through certain structures that we're going to talk about. It does not provide any relief for transferable credits. It doesn't provide any guidance whatsoever about transferable credits. So the best you can say about transferable credits is we kind of don't know, but that in and of itself may be too optimistic of an assessment, because given the way the model rules are structured, which we already talked about earlier, you're either a qualified refundable credit or you're not. And if you're not, it just goes into the numerator of your ETR. The credit just goes into the numerator of your ETR. So this is not one of those situations where you can sort of say, well, I'm kind of pregnant. You're either in this refundable credit category or you're not. And if you're not in this refundable credit category, then you have a problem potentially vis-a-vis the model rules and dropping below 15%. And I think the guidance from Treasury, people read it and interpreted it to be, oh, the transferable credits, they've addressed transferable credits, or they've addressed all of these credits with some sort of, sweeping kind of carve out. And the answer to that question is no. The guidance provided from the OECD is very limited, only to particular structures. If you happen to invest in something that generates green energy credits through one of those structures, you get the benefit of what's in the guidance, but that is very, very limited. So again, out over their ski tips, unfortunately, in that statement.
Okay, so let's dive in then into actually what that guidance said. So the administrative guidance provided relief for something they referred to as equity investment flow through election and qualifying flow through tax benefits that you mentioned before. So before we even dive into those elections, like what are equity partner investment structures? Because that's fundamentally what they mentioned here are these equity partner investment structures. You first need that before you can qualify for the qualifying flow through tax benefits or make the election.
Yes. So and I will say these structures are very common in the market, and they are a very common mechanism for monetize. Before we got to transferable credits or any of these concepts that we've spent the last few minutes talking about, this was the preferred mechanism, really the only mechanism for a lot of taxpayers to monetize credits, was to invest. So essentially what you would do, I'll give you a very simple example. You'd have, go back to my prior example, you have a developer or an investor who wants to invest in a green energy product, maybe wind farms, okay? But that investor, that developer, is worried they don't have sufficient tax base to utilize the credit. Obviously, the intent of the credit is to incentivize the investment. So The market developed a mechanism whereby an investor would come in. Now, in a typical case, this would be like a big bank. A big bank comes in, they've got plenty of tax base, they've got a large balance sheet. They would provide financing in the form of equity in a partnership. The partnership would own the wind turbines, in my example. Those would give rise to the credits. The credits would essentially flow out of the partnership to the investor, the bank that was providing the financing. The banks would be not the consolidated investor in this, but the equity method investor. So they would typically account for this under the equity method for GAAP. And so the concept of an equity method partnership is essentially just what I described. There's a partnership, you've got an investor who is getting the benefit of the credits. They account for that for GAAP purposes under the equity method. The credits all flow to them. The consolidated investor essentially is what we would often call the developer. In my example, the developer of the wind farm. They would essentially have economics associated with things other than the credits and other than certain other tax attributes like depreciation, which might flow out to the tax equity investor as well. So this is and we would refer to these structures generally as tax equity, right? And it was very common parlance that people would say, oh, that's a tax equity structure. So partnership, an equity method investor that provides capital, and essentially a developer that would be the residual, but also the consolidating investor. They would put the investments on their balance sheet for GAAP purposes, and the equity method investor would just be providing financing and would have the entitlement to the credits.
And how does, I'm going to get too deep into this, but generally the accounting for investment tax credits through equity method investments, how does that work, kind of in comparison to what we talked about with the earlier R&D credit?
Yeah. Well, the answer is there's not one answer. There's some flexibility under GAAP for how investors will account for the credits. And again, this is the tax equity investor, in my example, the bank that's providing this. They have options as to whether or not they would essentially have the entire benefit of the credit flow through the tax line, or if it would flow through as essentially partially offset by the amount of their investment. The timing of when they would take the credit for financial accounting purposes could differ. Do you take it over time as a recovery of the investment? Do you take it year by year as it essentially comes out of the partnership for tax purposes? So there's some flexibility associated with that. And to your point, I don't think we have time to dive way into the details of this stuff, but it's one of the challenges that the OECD, again, faced, going back to where we were at the start. The treatment of refundable credits, there's a fair amount of clarity and certainty with respect to the GAAP treatment of that above the line. You talk about these tax equity structures, these equity method structures, and the tax benefits that flow out of those. There's not one answer under GAAP. Taxpayers have some flexibility as to how they choose, depending on, obviously, there are all requirements under GAAP, but they have some flexibility as to how they choose to reflect this on their financial statements. And that is one of the challenges the OECD had to face. But from a GAAP perspective, taxpayers have flexibility in how they do this. And that's one of the important elements of the starting point for how you figure all this stuff out.
And my understanding for our listeners that are under IFRS, that there are similar type of policies that apply for IFRS. So then what did the administrative guidance say specifically related to equity investment, flow through election, qualifying flow through tax benefits?
Yeah, well, it's the first thing it said, and this was interesting. The original model rules essentially had a rule that said, the original model rules issued December of 2021 said, for purposes of figuring out the Pillar 2 base, investments that you account for under the equity method get kicked out of the Pillar 2 base. The pre-tax effect gets kicked out of the Pillar 2 base. That's in Chapter 3 of the model rules. Chapter 4 of the model rules says any tax effects of any item that's excluded from the Pillar 2 base in Chapter 3, kick out the tax expense associated with that. That's in Chapter 4 of the model rules. A number of investors in tax equity structures, these equity method structures, looked at this and said, it may be that we can read the model rules to say, we don't have to worry about any of this stuff. We're a tax equity investor. This is accounted for under the equity method. That tells us that our pre-tax and the tax effects, all the tax effects associated with this, get kicked out of the Pillar 2 base. So I don't have to worry about any of this, right? That was a question posed to the US Treasury Department and ultimately to the OECD and was taken up by countries. as part of the OECD process. The administrative guidance starts out by saying, not so fast. What we're going to tell you is these credits that flow through these equity method structures, you have to take them through your ETR for Pillar 2 purposes, unless they qualify for this new standard that we're going to create for qualified flow-through tax benefits. Okay, so the first thing they do with respect to this issue in the administrative guidance is, hey, all you guys out there who said that you're not going to have to worry about these tax credits if you were an equity method investor, that's wrong. You're going to have to worry about these credits. And if you want to get out of Pillar 2 or get out of worrying about Pillar 2, you need to qualify for qualified flow-through benefit treatment, which we are about to describe. And that's the first thing the administrative guidance tells you is you don't get a blanket out. Then it says, okay, there are certain structures where we believe we, the OECD and the participating countries, believe it's appropriate to provide special treatment. What is the nature of those investments? Well, it's an investment that I'll use the term cash flow negative, meaning the economic return that you, the investor, will obtain is made up primarily of tax benefits, right? You're going to invest $100, you're going to get back $120 over the course of that investment. Most of that return will be in the form of tax credits or other tax benefits. And it's got to be something that's accounted for under the equity method. If you're in that situation, then you have the ability to potentially apply this qualified flow-through benefit treatment. And this qualified flow-through benefit treatment essentially says, okay, to the extent of the return of your amount invested, you can ignore, for Pillar 2 purposes, effectively, you can ignore the diminution of your effective tax rate, the reduction in your numerator, up to the return of your amount investment. So going back to my simple example, if you invest $100 and you're expecting, I'll make it really simple, you invest $100, you're expected to get back $120 all in tax credits. The first $100 of return you get back in the form of tax credits, that does not affect your ETR for Pillar 2 purposes. Once you get to your $101st dollar, now it's treated just like any other non-refundable credit. It reduces your ETR. Now, for the investors in this space, this is a good answer. Empirically, it's a good answer because essentially they were looking at a situation where they were like, I was going to invest $100, get back $120 in credits. The entire $120 was going to be treated as a reduction in my ETR for Pillar 2 purposes. That's a terrible answer.
Right.
If I can get to the place where it's only the 20 that's treated as a reduction in my ETR, look, it's not ideal. I'd rather be able to ignore all 120, which is what I was hoping I was going to get with this equity method, just blanket carve out. But they've told me I can't have that. But I can kick 100 of it out of my computation. I only have to worry about the 20. Okay, I can live with that.
So transferable credits, we did not get a clear answer on. We now have this paradigm related to these equity structures. Right. How is that going to impact taxpayer behavior? Does this just create a huge market now for companies, taxpayers that are interested in the Inflation Reduction Act because of the uncertainty associated with the transferable credit? Is this just really going to balloon the market for these equity investment structures?
To me, this is going to be one of the most fascinating things to watch unfold because this will be entirely, assuming no further change in the rules, this will be entirely driven by taxpayer behavior in the market, right? And the question will be, exactly as you said, I have a credit that I am eligible to obtain, and it's a transferable credit. I don't have any guidance from the OECD on transferable credits. My assumption, therefore, is that every dollar of transferable credit that I monetize potentially reduces my ETR because I don't have a better answer than that. But even though that credit is transferable, if I invest with another investor in a tax equity structure and I take the benefit of the credit that way through the tax equity structure, I can qualify for this qualified flow-through benefit treatment, which will give me certainty of my answer. And again, going back to my simple example, if I'm going to get $120 of credits for $100 of investment, the first $100 of credits is going to be okay. There is so much we don't know about the sort of nature of the investments in this space as they go forward. for investments that potentially qualify for transferable credits. Now, we know some credits, for example, like low-income housing credits. Low-income housing credits will continue to go through tax equity. Nothing has changed in the Inflation Reduction Act to make them eligible for transferability anyway. So they're going to continue to utilize tax equity. But for things like production tax credits that typically in the past had always gone through tax equity, now you've got a choice. It's a transferable credit, but I don't know how to treat a transferable credit for Pillar 2, and I have a real concern that the treatment under Pillar 2 will be bad. I can get myself to a better place in terms of Pillar 2 treatment by continuing to go through a tax equity structure. Circling back to our policy discussion that we were having a few minutes ago about the R&D credit, Congress put transferability into the statute for a reason. They put it into the statute because they wanted to encourage new ways of monetizing these credits to encourage investment. So by not having clarity about transferability, are we essentially undermining what Congress was trying to do by leaving it essentially that if investors want clarity, they're back in tax equity? Well, but Congress clearly was aware of tax equity and had made a decision to say, we want to expand the potential market, make it, and introduce more flexibility in this space. Well, is Pillar 2 essentially frustrating the intent of Congress by saying, I understand maybe you wanted to do that, Congress, but these transferable credits, they're a problem. Do them through tax equity, maybe it's not a problem. So, and again, Doug, what's fascinating about this, the market will decide that.
Oh, yeah.
And so all we can do is watch and figure out for taxpayers as they're making these investment decisions, do you go to your investment committee ultimately and say, hey, we can do this through tax equity or we can do it through a transferable structure? My money says we continue going through tax equity, we continue pushing tax equity because of greater certainty. Or do we say tax equity is complicated, it's, in some respects there are economic inefficiencies associated with it. Again, this is some of what Congress was reacting to. A more efficient structure on a blank sheet of paper is transferable. Let's go with transferable. We don't know the answer to that question. I've had some conversations with some taxpayers who are big players in this space, and I've asked the question specifically, how are your front-end investment folks approaching this stuff? The answer is they're still trying to figure it out.
Okay.
So it's going to be fascinating, and we'll just have to watch and wait and see.
Yeah, and the story may not end here with the last administrative guidance, right?
Right.
I mean, we'll keep our eye on the US Treasury for any reaction.
Yeah.
Obviously, Congress has already sent some letters to policymakers, particularly at the OECD.
Right.
And then, of course, we also heard that there may be additional administrative guidance, but we have no idea if they will particularly focus on these transferable credits.
Yeah, and Treasury has made public statements recently saying essentially, hey, these transferable credits, we think they really should be treated like refundable credits. We think economically they're much the same, but Treasury in the same statements has acknowledged that the rest of the world may not see it that way. And so to the extent people are hoping for a quick, certain answer that transferable is the same as qualified refundable, I fear they're going to be waiting a long time. Potentially we never get that answer, but it's certainly not going to come very soon. And so I think this clarity from the OECD is unlikely to be coming in the near term. The market is going to have to react before that. Deals are getting structured as we speak in this space. So the market is going to have to start to speak, essentially vote with its feet in terms of which direction it wants to go.
Well, as we get any additional developments, we will bring you back for your 8th appearance to talk about Pillar 2 and very fascinating discussion, Pat. I think you've had a lot of clarity, so thank you.
Absolutely. Great to be here, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pat Brown, co-leader of PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services global leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.